Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we're working on the Chapter 2, Analyzing and Recording Business Transactions. And this is the fourth video in the series. And in the previous video, I had gotten halfway through with how to make a journal entry. So I'm going to pick up where I left off. And if you haven't watched the previous video, go back and watch that video. I mean, it was 21 minutes long, so I decided to make another video, break it and make another video. So if you haven't seen that other one, go back and watch it. So picking up where we left off, all right, I'm going to erase this here, right, to clean this up, right? And remember, revenues, the normal balance of a revenue is a credit, and for expenses, the normal balance of an expense is a debit. Okay, so whenever I'm making a journal entry, right, don't jump to the second half of the journal entry. Ask yourself first, am I affecting cash? And if the answer is yes, then you know what to do. If my cash is increasing, I'm going to debit it because the normal balance of an asset is a debit. And if my cash is decreasing, well, then it's the opposite, which would be a credit. Okay. And if you've done enough of these transactions, that becomes almost rote. I mean, 30, 40 transactions, affecting cash, you're going to know, and my cash increases, I'm debiting it. My cash decreases, I'm crediting it. You don't have to be thinking about the normal balance of an asset, right? But that's the first question you ask. Does this transaction affect cash? And if it's yes, you know how to make that first half of the journal entry. But if the answer is no, okay, then you move on to the second question, all right? Your second question being, does this transaction affect accounts receivable or accounts payable? Okay. Now remember, accounts receivable and accounts payable, the terminology that you use for both of these is on account, right? So if I'm buying supplies on account, right, that means I'm buying something on credit. Okay? If somebody's buying off of, if I'm making a sale on account, that means I'm extending credit. So your accounts receivable is what you use for your customer, all right? When they're buying something off of you, you're making a sale and you're extending them credit on account. So you're using the accounts receivable. But for the accounts payable, you're talking about a vendor that you're purchasing from, right? They're extending you credit on account, right? So if you're buying something off of somebody else, you use accounts payable. If somebody's buying something off of you or you're making a sale, you use accounts receivable. But notice that these here are two sides to the same coin, okay? So if you know how to do one, you do just the opposite for the other, meaning if you know how to do accounts receivable, all right, and if you know that the accounts receivable should have a debit, well, just the opposite for accounts payable, right? That's a credit, right? And if you think about it, let's say a company is buying something from you, okay? Well, you're making the sale, okay? So you would end up debiting your accounts receivable, but on their set of books, right? The customer, right? On their set of books, for them it's accounts payable because they owe it, okay? And for them it's going to be a credit. So that's what I mean by two sides to the same coin, right? They're both on account, right? But they're just opposite of each other. So if you know one, you know the other. Now, here's the real easy catch to it. Okay, remember, learning is about, you learn easiest by association. Okay, and here's the association. Right? Well, what is an accounts receivable? All right. Well, it's something that you own. Why? Because somebody owes you money. Well, accounts receivable is an asset, right? Well, here's the association. What do you know that's also an asset? Cash. So if you know how to do cash, and after, like I said, after like 20, 30 transactions using cash, you should start getting to the point where you understand, whether you're debiting or crediting cash, you know, accounts receivable is an asset, so you think along the same exact lines as cash, meaning accounts receivable is an asset, right? And if my accounts receivable is going up, okay, that means I'm going to debit my accounts receivable. If my accounts receivable is going down, I'm going to credit it, right? That's how easy it is, all right? So when I'm making a journal entry, if I have a debit, I start out with my debit and credit, okay? And let's say, somebody is buying something off of me, okay? Well, and they're buying it on account, all right? Well, if they're buying it on account, that's an accounts receivable. And if, let's say, they owed zero before, and now they're going to owe $200, didn't that increase, right? Didn't that increase? Yes. So my accounts receivable increases, right? And since it's an asset, I'm going to increase it on the debit side. So my accounts receivable is a debit. Or I could have thought along the lines of accounts receivable is just like cash, and I increase my cash on the debit side, so I increase my accounts receivable on the debit side, right? Same thing, $200. And just like before, debits have to equal credits. So if I debit something for $200, I have to credit something else. Well, what is it? Okay. Well, I go back up to here, to my categories of accounts. All right, let me erase all of this. I'm back up here thinking about the categories of accounts. If I'm selling a product, okay, I know it's not an asset because it's a sale. I know it's not a liability because it's not something I owe. It's not an investment in the business. We know revenues is where we make the sales and the operation of the business. So I look underneath revenues and I look at the accounts that are under it and I choose the most appropriate account. So my credit then would be sales revenue. And I have the correct journal entry. See how I just back into it? I don't have to think about whether sales revenue is a debit or a credit. I automatically back into that credit. Okay? Depending upon the way the transaction is worded, you may determine that you should be using the sales revenue account, but you may not be sure if you should debit it or credit it. Okay? But if you think from the perspective of, am I affecting cash? Yes or no? No? Okay. Am I affecting accounts receivable or accounts payable? Yes. Okay. Well, which is it? Receivables or is it payable? And if it's a receivable, you immediately back into the credit, to the sales revenue, and you don't have to worry about it. Okay. So with that said, the vast majority, okay, what's going on here with my pen? There's little buttons on the pen itself, and I keep on turning the pen in my hand and my fingers and pushing the buttons. So if I ask myself, am I affecting cash? Yes, I know what to do. If it's no, then I ask, am I affecting accounts receivable or accounts payable? Okay. If the answer to that question is yes, then I determine whether it's receivables or payables. Well, I just showed accounts receivable saying an increase is a debit and a decrease is a credit. But remember, I had also said that if it's an accounts payable, let's say I'm purchasing something from a vendor, okay, well, it's just the opposite of the accounts receivable, meaning my accounts payable, I owed them zero before, and now I'm buying something for $150 on account. Well, if I'm increasing, okay, my accounts payable, I can look at this two ways. I can associate it with the accounts receivable saying, oh, I increased the accounts receivable on the debit side so the opposite side of the same coin is an increase in accounts payable would be a credit, right? Because it's the opposite, right? Or I can say accounts payable, is something that I owe. And when I owe something, that's a liability. And since for liabilities, I increase my liabilities on the credit side, I know that my accounts payable, I'm going to credit it for $200. And then I debit something else for $200, whatever that might be. If I'm buying, let's say say, I don't know, a newspaper, okay? Well, I might not have an account called newspaper expense account, but I might have an account called, miscellaneous expense. Okay? And how do I end up with that? Again, I'm looking at the categories. If I'm buying a newspaper, is that an asset? No. It's not something I own. You could say, well, I own the newspaper. No, you're probably buying it, as part of the operations of the business in order to check out, advertising that you might have done. Okay, so the newspaper is an expense, all right, or it might be an entertainment expense. Okay, the point being is that you're buying the newspaper because it's the normal part of the normal operation of the business. It's not because you're buying an asset that has value down the road. You buy that newspaper for $1, tomorrow it's worthless. You buy that computer for $400, tomorrow it's still worth almost $400. Obviously it's not something you owe, and it's not an investment in the business, and of course it's not a sale, so it has to be an expense. And you would look underneath the expense and determine, pick one of the accounts that are under the expense account. Okay? And that's what you would use for the other half of your journal entry over here. Okay? So you've gone through and we've asked ourselves, these first two questions. Am I affecting cash? No. Then I ask, am I affecting accounts payable or accounts receivable? And if my answer to that is no, okay, then I go to an account that makes the most amount of sense. Okay, and what I mean by that is now you look at your chart of accounts, and depending upon what the transaction states, you look for that ledger account that would fit into that category of accounts. Let's say, I'm going to try to think of something here. Let's say the transaction was something like you went to the bank and you had signed a note payable in the amount of $500 due in 90 days. Okay. Now, my first question that I would ask is, am I affecting cash? And in this case here, it would be yes, because why? I'm going to get $500. Now let me change that a little bit. Let's say I go to the bank and I get a note payable for a $500 credit due in 90 days to be used against the purchase of an investment of some sort, right? Maybe a stock investment or something. I don't know. Okay, so you ask yourself the question, does this affect cash? No, because you're getting a credit, you're not getting the cash. Okay, does this affect accounts receivable or accounts payable? No, all right, because you're getting a note payable and it's giving you a credit. So then you go to 3, an account that makes the most amount of sense. The account that makes the most amount of sense in this case here is a note payable, right? Why? Because you can recognize that a note payable is a liability, and you know that then for the note payable it was 0 and now it's increasing to 500. So that means I increase my liabilities on the credit side, so you'd have a credit to note payable for $500. And then all you have to do is, look to see, figure out what goes in the debit. Okay, you would look under, you would say to yourself, okay, is this an asset? No, because it's not something I own. All right, is this a credit? Is this something I owe? I know I did not say what this credit is being used for. I said it's for a stock investment, and the reality is that this probably, the other half of this transaction would be an asset. Okay, but I'm getting into something a little bit more advanced, and I'm just trying to make the point here of being able to look at what you know first. In this case here, I know the accounts payable first. Okay, so I can figure out that half of the transaction, and then all I need to do is just look down through my accounts to be able to figure out the other half of the transaction, and it will fall into place. I don't have to struggle so much with trying to figure out what that second half of the transaction should be. Okay, so I'm working this off the cuff, and I'm just getting an idea in my head. So, bear with the example, okay? But the point being here is that I'm not using cash, I'm not using receivables or payables, but I know I'm using a note payable for 500. And because I know that, and I can associate that with my liability, I know that I can credit my note payable, and then since debits have to equal credits, okay, I'm able to look at my ledger accounts and back into whatever account that would be as a debit for $500. And my journal entry would be right. Okay, so that's my thought process when I think about journal entries. Now, notice I'm only making 2 line items for my journal entries all the time in these examples. I can use more than one line item. Like, for example, when you're doing payroll, okay, you can have 5, 6, 7, 9, general ledger accounts as part of that one journal entry, okay, and you're able to back into them all right? But I go through this thought process right here, okay, in making journal entries, and I'm just going to touch upon something that we're going to be addressing in the next chapter. I'm talking about making a journal entry, but there's more than one kind of journal entry. Yeah, there's a journal entry that you make for your transactions in the normal course of your business, but you also have adjusting journal entries. You also have correcting journal entries. Okay, you also have closing journal entries. Okay, but regardless of which one it is, a journal entry is a journal entry, and the same thought process can be applied to whatever type you have. Okay, and the reason why I went into this little diatribe, this little spiel about the different kinds of journal entries, in that in your normal transactions, okay, during the course of the business, the vast majority of your transactions, you'll deal with number 1 and number 2. And you might have some of these for number 3, okay? But when you start working with adjusting entries, you're going to be dealing with number 3 primarily, okay? And your closing entries and your correcting entries, they're based upon what you've already done before, okay? You're going to be, it's sort of like a credit memo where you end up reversing what you've done before. But your adjusting entries deals primarily with number 3. So this thought process allows you to be able to use, work with whatever type of journal entry that you're making, okay? Now, I hope you understood that from the previous video and this video, okay? If you haven't, go back and watch the previous video and this video. Try to follow the process, but here's what I'm going to stress. As I was creating the slides for the homework problems for the assigned to this chapter, you're going to be making a lot of journal entries, all right? And when I'm showing you how to make those journal entries, I'm going to be going through this thought process, okay, to make those journal entries. So, if it says paid rent for $1,000 for August, okay, if that's what the transaction says, I mean, to me, it's just so ingrained. I know that's a debit to rent expense for $1,000 and a credit to cash for $1,000. I mean, I don't have to think about it. That's memorized, that's internalized. But instead, when I'm going through those journal entries In the homework exercises, I'm going to be trying to work through and speaking through this thought process so that you can determine that journal entry, so that that process becomes ingrained in you until you get to the point where you are internalizing the journal entries, and anytime that you come across an entry you don't know, you have something to be able to fall back on in order to be able to make the journal entry the correct way. Okay, so with that said, I'm done with how to make journal entries, which means in my next video, I'm going to cover T accounts, which shouldn't take that long, and I think I will probably go into the trial balance in the next video also. All right, so I will see you then. Again, if you don't understand something in this video, feel free to telephone and speak to an instructor. But realize on how to make journal entries, that's the way I personally think about making the journal entries. All right, so see you in the next video.